Those movements, let's bring in Makwe Masilela from Makwe Fund Managers. A very good evening to you, Makwe. And the JSE trading in stark contrast to what we've seen over the last few days, where it was in the green with gains across most of the major indices. Not a great trading day for the JSE today. What would you say were some of the biggest drawbacks in the losses today?
I think just what is happening internationally, market participants are more worried about the slowing global economies, as we've seen with the PMI numbers, starting with the Chinese one, their services not looking that great. Also, when you go to Europe itself, it shows that their services, including manufacturing, not doing that great. And yes, the US one, it did manage to go up, but not as much as expected. But at least ours has done much better. We've managed to see the first growth, at least in a period of 6 months. But generally, the sentiment is that markets are more worried about the global economic growth. And to make things even worse, yesterday, the European Central Bank president didn't give us a hint of whether they will hold or increase interest rates when they make their decision next week on the 14th. So markets are saying, listen, things are not looking that great. We can see oil prices also going up, also putting more pressure on companies, as we know that ultimately is pushing pressure on economies because that increases the cost of doing business itself.
And what also increases the cost of doing business, Makwe, is the skyrocketing prices of fuel that we're seeing. And it doesn't help that Brent has now touched $90 for a barrel. As a net importer like South Africa, this is going to hurt us even more, not just as motorists, but as businesses that use fuel intensively in their operations. So the rand being weakened as much as it has at the moment, and also the price of Brent, and not a good combination for an economy that is struggling, albeit the 0.6 growth that we saw today.
Coupled with load shedding, that doesn't bode well at all, when it comes to the South African consumer or firms, as you said earlier. But now the problem here is oil manufacturers, they also have to make sure that they earn money. And for them to do that, OPEC and others, they continue to make sure that at least they get prices to be at elevated levels. Today, we've seen the de facto leader of OPEC, which is Saudi Arabia, saying their supply cut of 1 million barrels per day will be extended for the whole of the year. And we know that Russia was also doing the same, cutting by only 500,000 barrels. So as from September, they will only cut by 300,000. So that will continue to keep oil prices at elevated levels. But yes, you are right, that increases the cost of doing business, as we've seen with some companies spending billions when it comes to diesel costs. And it's not only just manufacturers, we are also just talking all aspects of our lives, because any aspect of our life have a component of transport, whether you are a farmer or you are just a consumer or just a worker going to work or kids going to school. That increases all those costs. And as we've been complaining, the cost of living, they continue to be at high levels, and that doesn't bode well as well when it comes to our interest rates going forward.
Absolutely. One gift that keeps on giving, Makwe, is a Shoprite. They are seeing a record increase in market share. So they have shown, unlike your other retailers, a Pick n Pay, for example, that has struggled quite a bit, that they have remained resilient in their core market, but also the higher end market that targets the same Woolies customer, if you will, Makwe. They are dominating and they're doing quite well. Even though they're having to spend more, they're seeing that those profits are coming in, and they're coming in strongly.
Definitely. When it comes to the higher LSM, they're continuing to chow the likes of Woolworths. I mean, the guys, they managed to increase their sales by almost 18%. And market share, I think it was increased by 1.4%. And are well represented when it comes to the lower LSM, the likes of your Shoprite, the likes of your USAFE, continuing to do well, increasing sales by over 15%. And we know that the sector where more than 50% of our people spend more than 60% of their money on food. But the diesel cost of 1.3 billion, that's just too much. And revenue just went up by 6.9%. And their headline earnings per share by almost 9.6%, and increased their dividend by 10.5%. But bearing in mind that the likes of Woolworths as well, they're starting to move into the township as well. And we know that Pick n Pay as well with their new strategy, they're making serious inroads when it comes to a lower LSM. So I think it's worth watching that who's going to end up being the dominant player. But as it is now, I mean, Shoprite with almost 3,328 stores compared to that one of Pick n Pay. Pick n Pay, I think they've got 1,628 stores, and the market value of Pick n Pay is a mere 18 billion. And that one, when it comes to Shoprite, you are talking a whopping 155 billion. So yes, you are right. Shoprite continued to be the big player.
Yeah, Makwe, I'm going to be interviewing Peter Engelbrecht, who's the CEO of Shoprite, in the next hour. If you had one question for him, what would it be?
That what are the chances that the likes of Pick n Pay will start giving them a serious challenge, especially when it comes to the middle LSM, because there we know you've got the likes of Spar and that they are not playing that much when it comes to a lower LSM. So far we've seen that they've been managing to grow by opening more stores. I think they opened just over 300. So store for store, like for like, how do they expect to do going forward?
Oh, that's going to be an interesting answer to hear from. I hope you'll be watching, Makwe. Some other updates we have there is a Robosis property fund. It was once quite the darling, Makwe. It was nice to see a property fund of its nature listing on the JSE a few years ago. Now it finds itself in a very precarious position. The business rescue that it's currently under, the selling of assets. It's just put out a SENS announcement of the second tranche of assets worth 650 million rand that will be sold off under the current business rescue practice. Your thoughts on Robosis, and are we nearing the end of the REIT?
Yeah, and it's just so unfortunate, as you said, used to be the darling, the first black-owned and managed, property company to be listed on the JSE. But we can all blame this to debt, and they'll be sitting with a debt of just around 10 billion. And we know they started to move into the UK. And remember that scandal when it comes to the resilient, property stocks, that also affected them. The BRICS issue when it comes to the UK businesses and COVID as well. So it was not that great for them. And also the guys started to struggle repaying the interest on the debt, not yet the debt, but just the interest itself. And also we've just got confused when it comes to their strategy going forward. Whether do we just want to be a landlord when it comes to retail only, or you want to be the likes of Hyprop competing with the guys who own the likes of your Hyde Park Corner, or maybe you still want to have a mix. And we're convinced for a long time that if you've got government as a tenant, you are safe. But they made us realize that government itself, doesn't pay on time. As a result, that affected their cash flows.
Yeah, no, government as a client has been very tricky and sticky for a lot of the businesses that are listed on the JSE. Makwe, as always, thank you very much for that update this evening. That is Makwe Masilela, who's from Makwe Fund Managers, wrapping up at the Markets Day that was.